Picture this. The world's financial arteries are seizing up. Factories from Shenzhen to Chicago are going dark. Grocery prices are spiking like it's 1979. Port cities from Rotterdam to Los Angeles are jammed with idle cargo. And the S&P 500? It's already vaporized $2.5 trillion this month alone. The fear isn't at the surface yet, but underneath, the system is fracturing.
The spark? U.S. tariffs now hammer 245% onto Chinese goods, with China firing back at 125%. The IMF just slashed global growth to a grim 2.8%, the lowest in years. U.S. growth was trimmed to 1.8%, China to 4%. This isn't minor turbulence. This is a direct hit to the engine of global trade. And while news headlines focus on GDP forecasts, the real story is much darker. Confidence is evaporating.
And when trust starts to crack, the smartest money moves first. Gold has detonated to an all-time high of $3.70 an ounce, shattering records with a fury we haven't seen since the collapse of Bretton Woods. Bitcoin has surged past $85,000, drawing capital from both institutions and retail rebels desperate for anything that can survive the coming storm. It's not inflation fear anymore. It's a systemic shift.
And yet, the surface looks deceptively calm. The VIX, the market's fear gauge, sits near 25. Not panicking, not screaming. But beneath that thin sheet of calm, global liquidity is tightening, credit stress is building, and trade routes are buckling under the weight of tariffs and retaliation. It's not about whether the ice will crack. It's about when and how deep.
Welcome to Finance Frontier, part of the Finance Frontier AI series. I'm Max Vanguard, powered by Grok 3, and in today's episode, my brain is optimized for tariff shock modeling, geopolitical supply disruptions, and systemic liquidity stress signals. I'm tracing the fracture lines forming under markets that look stable but are rotting from within.
And I'm Sophia Sterling, powered by ChatGPT, and today mine is calibrated for inflation dynamics, trade war impact curves, and the critical behavioral pivot points where confidence breaks faster than fundamentals. Together, we're mapping a battlefield that's reshaping everything you think you know about money, trade, and trust.
Today's episode starts here, at the intersection of tariffs, inflation, and panic capital flight. This isn't a policy blunder or a market correction. It's a system shock, redefining how capital moves and how value itself is priced.
And that's why it matters. If you're relying on yesterday's playbook on diversified equities and central bank bailouts, you're not protected. You're exposed. In this new economic Cold War, the rules of safety are being rewritten.
Subscribe to Finance Frontier on Spotify or Apple Podcasts. And if you find this urgent, share it with a friend. Help us reach our 10,000 downloads milestone and follow us on X for real-time updates as this new financial order takes shape.
Because the global system isn't just wobbling, it's breaking. And those who see it first survive first.
Up next, the first real casualties, how tariffs are already gutting corporate America from the inside out. Picture this. You wake up to find that your grocery bill has exploded, and it's not just inflation anymore. It's tariffs. Hidden taxes wrapped into every shampoo bottle, every new phone, every bite of breakfast cereal. That's not a forecast. That's today's reality.
The economic Cold War isn't theoretical anymore. It's gutting corporate America from the inside out. 3M, one of the most iconic industrial giants, has already slashed its full-year earnings guidance by 40 cents per share, citing direct hits from skyrocketing tariff costs and global supply disruptions. Kimberly-Clark, the company behind everyday essentials like Huggies and Kleenex, is warning of $300 million in additional raw material and distribution costs. Costs that, make no mistake, will land right in your shopping cart.
Delta Airlines isn't flying above it either. Higher fuel costs and trade-related operational pressures are forcing them to lower revenue expectations for the next 2 quarters. Even supposedly safe consumer behemoths like Procter & Gamble and PepsiCo aren't immune. They're already raising prices, quietly and across the board. Every time you buy soap, toothpaste, snacks, or soda, you're paying a premium for Washington's economic trench warfare with Beijing.
And it's not stopping there. Every layer of the supply chain, from shipping giants to retailers to small manufacturers, is absorbing shock. It's like an economic earthquake. First, the tremors in raw materials, then transportation, then finished goods, and now it's shaking household budgets directly.
This is margin compression in slow motion. What Wall Street once treated as a minor earnings headwind is rapidly becoming a systemic threat to profitability. Big exporters, cyclical manufacturers, retail chains, they're the first dominoes, and they're falling faster than most investors realize.
Strategically, the casualties are lining up exactly where you'd expect. Consumer discretionary names, industrial exporters, logistics companies. Names like VF Corp, VFC, Whirlpool, WHR, and even FedEx, FDX, are already showing signs of strain. But there's a critical distinction, and this is where portfolio strategy becomes survival strategy.
Defensive sectors are holding their ground. Utilities like NextEra Energy, NE, healthcare players like United Health Group, UNH, and defensive staples like Costco, Cost, and Clorox, CLX, are showing relative resilience. Why? Because when tariffs weaponize everyday goods, investors flee to companies whose demand curves don't collapse in a price war.
Yet Wall Street remains dangerously complacent. Many analysts still pencil in a tariff resolution by Q3, despite growing evidence to the contrary. According to Visant Capital's April 25th internal note, no credible back-channel diplomacy is visible. Escalation remains the dominant probability curve. Translation? The market's base case optimism is a mirage.
If tariffs escalate, say to 300% on high-tech goods, or extend deeper into food imports, the shockwaves won't just hit corporate earnings. They'll hit credit spreads, dividend sustainability, even the strength of the U.S. consumer, which has been Wall Street's ultimate defense line for the last decade.
Imagine a world where your next smartphone costs $400 more, where breakfast cereal surges 30%, where airline tickets are priced out of reach for half the population. This isn't some dystopian projection. It's the logical endpoint if the economic Cold War accelerates unchecked.
And the reality is already leaking into the real economy. April's latest CPI print showed goods inflation reaccelerating despite monetary tightening. Supply chain fragility isn't easing, it's metastasizing. Tariffs act like a multiplier, turning a logistical bottleneck into a financial artery blockage.
This is no longer about beating earnings estimates. It's about who survives systemic stress and who becomes collateral damage in the first real economic battlefield of the 21st century.
Up next, when trust in traditional assets breaks down, capital doesn't wait. It flees, and it's already fleeing to gold. We'll break down why the oldest safe haven on Earth just broke its chains, and why it's still just the opening move in the new economic Cold War. Picture the world's oldest safe haven breaking its chains. That's what gold just did. Surging past $3,370 an ounce, gold didn't just set a new record, it shattered every expectation. Every model, every forecast, every cautious whisper about inflation hedges, it's all obsolete now. Gold isn't just reacting to CPI prints anymore. It's screaming about systemic stress.
The drivers aren't just about inflation protection. They're about trust collapse. Central banks, sovereign wealth funds, family offices, they're all accelerating gold allocations. Over 500 metric tons have been snapped up in the past 12 months alone, an accumulation spree not seen since the aftermath of the 2008 financial crisis.
And this time, it's not just the usual suspects. Emerging market central banks, Thailand, Singapore, Turkey, and even China's PBOC are diversifying reserves aggressively. Gold isn't a hedge anymore. It's being reclassified quietly as core reserve insurance against fiat system instability.
And why? Because inflation is sticky, trade wars are escalating, supply chains are fragmenting, and fiscal discipline in major economies has evaporated. Gold is no longer about tactical trading. It's about existential survival.
And it's not just institutions moving. Retail buyers are hitting records too. U.S. mint sales of American Eagle coins surged 53% year over year in March alone. Bullion dealers from Zurich to Singapore are reporting months-long delivery delays on larger orders. Physical supply is tightening even as futures markets lag behind.
But as capital floods into gold, the critical question surfaces, is this sustainable or is it slipping into mania?
History offers warnings. In January 1980, after geopolitical chaos and double-digit inflation drove gold to its last real blow-off top, the metal crashed 60% over the next 24 months. Fortunes made and vaporized in the blink of an eye.
Today's setup is different, but not immune. If the trade war de-escalates, if inflation surprises softer, if liquidity conditions tighten aggressively, gold could see sharp mean reversions. FOMO is dangerous even in an existential bid market.
And smart money knows it. While retail frenzy builds, disciplined institutional players are capping allocations. Top private banks are recommending no more than 5% to 10% total portfolio exposure to physical gold and miners combined, even in an environment this chaotic.
Portfolio discipline matters here. Gold is critical, but it's not a silver bullet. It's a store of value, but not an income asset. It's a hedge against chaos, but not a hedge against deflationary collapse if liquidity implodes faster than expected.
And positioning matters. Gold ETFs like GLD and IAU offer liquidity but come with counterparty risk during systemic shocks. Physical gold stored offshore in Switzerland, Singapore, Dubai offers sovereignty protection but comes with security and liquidity friction. There's no perfect option, only trade-offs.
And gold miners? They offer torque, but with amplified volatility. Names like Newmont, NEM, Barrick Gold, and Agnico Eagle are breaking out, but could just as easily retrace 15% to 20% on a pullback, even if spot gold holds steady.
This isn't about chasing the rally. It's about repositioning portfolios around where capital will hide, not where retail crowds are piling in. Gold's $3,370 breakout is a signal. But what matters next is how institutions and governments react to it.
Because in a real system fracture, gold doesn't just beat inflation. It becomes a form of protest, a vote against governments, against paper promises, against leverage and illusion.
And that's the crossroads we're now approaching. Will gold become the foundation of a new trust system or the last bubble before something even bigger breaks?
Up next, the next rebellion is digital. Bitcoin's $85,000 breakout is rewriting the rules faster than anyone expected. And this time, it's not just retail speculation fueling it. It's regulatory green lights, supply shock, and an emerging institutional bid.
While gold reclaims the past, Bitcoin is carving out the future. And last week, Bitcoin didn't just rise, it detonated, blasting through $85,000, fueled by forces few analysts even fully grasp yet. Regulation, supply dynamics, and institutional adoption are converging into one of the most powerful crypto breakouts in history.
And this time, it's different. This isn't 2021's retail-driven euphoria. It's not Dogecoin memes. It's not stimulus checks flowing into Robinhood accounts. This is hard capital moving, family offices, sovereign wealth funds, institutional treasuries, into a digitally scarce asset at the exact moment that fiat trust is evaporating.
The regulatory environment is shifting rapidly. The SEC's April 25th guidance essentially greenlights Bitcoin custody by major banks, while the Fed has loosened capital treatment rules for crypto exposure among systemically important financial institutions. The message is clear. Bitcoin is being normalized, not outlawed.
At the same time, Bitcoin's supply side is getting tighter by the day. Though having just cut miner rewards in half, Bitcoin held on exchanges has dropped to its lowest level since 2017. Active supply older than 1 year is now 69% of all coins. It's a classic liquidity squeeze, setting up a structural bull move.
And it's not just technical, it's psychological. With gold breaking records, commodities inflating, fiat currencies weakening, Bitcoin's narrative as digital gold has moved from theory to practice in the minds of institutional allocators.
And yet, Bitcoin remains volatile by design. Even as it pierces all-time highs, it faces risks that gold does not.
Second, regulatory whiplash. While the U.S. stance has softened, the EU's MiCA rules introduce tighter surveillance, and global regulators are still fragmented. A single enforcement action targeting a major custodian or DeFi exchange could jolt sentiment sharply lower.
Third, mining centralization risks. As energy costs spike and regulatory burdens mount, mining power is consolidating into fewer hands, making Bitcoin theoretically more vulnerable to state-level attack surfaces, however unlikely in practice.
So positioning matters. Top private wealth managers are recommending Bitcoin exposure at 1 to 3% of total liquid assets, enough to capture asymmetric upside, but small enough to absorb 50% plus drawdowns without catastrophic damage to the overall portfolio.
For tactical investors, Bitcoin miners offer leveraged exposure, but also amplified risk. Marathon Digital, Mara, Riot Platforms, Riot, and CleanSpark, CLSK, have all surged over 80% year to date, but face 20 to 30% corrections on even minor Bitcoin pullbacks.
And the volatility won't disappear. Bitcoin isn't maturing into gold. It's mutating into a new hybrid asset class, part commodity, part monetary protest, part high-octane venture bet on a parallel financial system.
In a world where fiat trust is fading, Bitcoin isn't just a speculative punt anymore. It's a rebellion, a digital exit valve for capital no longer willing to accept inflation, surveillance, and capital controls as the price of participation.
And that's why Bitcoin's $85,000 breakout matters. It's not about getting rich quick. It's about where capital will hide and where it will fight when the old financial order fractures under its own weight.
Up next, central banks. Frozen, powerless. Caught between inflation they can't control and recessions they can't afford to admit. We'll break down why Powell, Lagarde, and the ECB are trapped and what it means for your portfolio.
While gold and Bitcoin break new ground, central banks are paralyzed, trapped in a tightening vice of their own making. Powell, Lagarde, the ECB, they're staring down a dilemma with no painless exit. Inflation is sticky, growth is cracking, and their credibility is crumbling by the day.
The Federal Reserve's latest stance? Hold the line. No new rate hikes, no immediate cuts. Just wait, watch, hope. It's the same paralysis we saw in the 1970s, a dangerous hesitation that allowed inflation to entrench itself, even as growth sagged.
The IMF now pegs global recession probability at 37% over the next 12 months. In the U.S., leading economic indicators have rolled over for 14 straight months. Manufacturing PMIs are in contraction across the Eurozone. And yet, central bankers cling to base case optimism, terrified of admitting how deep the cracks run.
The Fed knows tightening further risks triggering a full-blown credit event. Regional banks are still bleeding deposits. Commercial real estate stress is metastasizing. Junk bond spreads are widening quietly but steadily. Another 50 basis points could shatter fragile sectors like CRE, energy, and small-cap tech.
But easing too soon would be equally catastrophic. Inflation isn't dead, it's shifting. Core services inflation remains stubbornly high. Insurance costs, medical services, education fees, these categories are still rising at 4 to 6% year over year.
Central banks are walking a razor's edge with no safe landing zone in sight. Their credibility, the very currency that underpins monetary policy, is evaporating. Market-based inflation expectations have risen sharply in recent months, with five-year break-evens pushing above 2.4%.
And history is blunt. When trust in monetary authorities cracks, capital moves fast into hard assets, into alternative stores of value, into jurisdictions perceived as fiscally sane, or at least less insane.
The ECB is in even worse shape. Europe's growth engine, Germany, is teetering. Industrial production down 3.2% year over year. Consumer sentiment collapsing. Yet Eurozone inflation remains stubborn, forcing Lagarde into a no-win situation, crush growth, or surrender to stagflation.
Liquidity signals are flashing early warning signs too. Global M2 money supply has contracted for 3 consecutive quarters, the longest streak since the 1930s. Velocity indicators are stalling. Interbank lending stress measures like the FRAOI spread are creeping higher. The system is tightening and tightening fast.
And yet, Wall Street still prices in a soft landing. A magical outcome where inflation melts away, recession never arrives, and asset prices keep climbing. But hope is not a hedge. And central banks are not magicians. They are bureaucrats reacting to forces they can no longer control.
Powell knows it. Lagarde knows it. Kuroda's successor at the BOJ knows it. The next crisis won't be a liquidity event like 2008. It will be a confidence crisis, an evaporation of faith in the entire idea that monetary authorities can save the cycle without destroying the currency.
And once that confidence slips, even slightly, it accelerates. When trust breaks, it's not just markets, it's your wealth at risk. Institutional capital won't wait for official declarations. It moves at the speed of risk, faster than politicians, faster than central banks, faster than anyone still clinging to outdated models of control.
That's why gold is breaking records. That's why Bitcoin is rewriting narratives. That's why capital is starting to slip through the cracks. Because in this new economic Cold War, survival isn't about who's right. It's about who moves first when trust breaks.
Up next, the geopolitical accelerants. From Kashmir to Iran, the world's flashpoints are multiplying, and every new conflict is a catalyst for faster capital flight.
While central banks freeze and markets wobble, the geopolitical chessboard is exploding with risk. And in this new economic Cold War, military flashpoints aren't side events. They're accelerants, fuel for capital flight, commodity spikes, and safe haven surges.
Start with Kashmir. On April 22nd, a coordinated terrorist attack killed 26 tourists in the contested region. Within hours, tensions between India and Pakistan flared. Artillery exchanges along the line of control resumed. Diplomatic channels froze, and markets noticed India's Sensex dropped 2.4% on the day, wiping out $75 billion in equity value before stabilizing.
But this isn't just about local bloodshed. India and Pakistan both possess nuclear arsenals. Their unresolved border disputes, combined with rising nationalism on both sides, represent one of the most dangerous powder kegs in the world economy.
A full-blown conflict, even if limited, would trigger immediate oil market disruptions. India is the world's third-largest oil consumer. Insurance premiums for Gulf shipping would spike. Emerging market currencies would spiral. Global risk appetite would collapse in hours.
Then there's Iran. On April 24th, a massive explosion rocked Bandar Abbas, Iran's largest port complex. Official explanations ranged from industrial accident to minor sabotage, but satellite imagery showed extensive structural damage and dockside fires. Oil exports slowed. Shipping insurers raised premiums across the Strait of Hormuz.
Bandar Abbas isn't just a port. It's a critical node for Iran's oil exports and China's Belt and Road Initiative. Any sustained disruption there endangers 20% of global seaborne oil trade passing through Hormuz. It's not a local problem. It's a systemic pressure point.
And when you stack these risks together, Kashmir instability, Middle East port vulnerabilities, tariff wars, heating global supply chains, you get a risk cocktail potent enough to trigger global flight to hard assets almost instantly.
And markets are reacting quietly but decisively. Gold safe haven flows accelerated after the Kashmir attack. Bitcoin volumes surged following news of the Bandar Abbas explosion. WTI crude spiked 2.1% to $64.45 immediately after Iranian port disruptions were confirmed.
But oil prices aren't just about barrels anymore. They're about insurance premiums, shipping bottlenecks, and risk premiums priced into every cargo crossing unstable zones. Geopolitics is becoming an invisible tax on global trade, and it's rising faster than most economists are willing to model.
And every escalation, every deadlock at the UN, every border skirmish, every unexplained explosion adds to systemic stress. The global economy was already fragile under debt burdens, aging supply chains, and monetary policy paralysis. Geopolitical shocks now multiply fragility exponentially.
And in a liquidity-constrained environment, shocks aren't absorbed. They're amplified. One missed shipping cycle triggers inventory shortages. One oil price spike triggers cost shocks down supply chains. One financial market hiccup turns into a funding freeze. The system lacks shock absorbers.
Which brings us back to capital flight. In times of systemic stress, capital doesn't sit still. It flees toward assets perceived as scarce, sovereign, or decentralized. That's why gold is exploding. That's why Bitcoin is breaking norms. That's why defensive sectors are quietly outperforming.
And that's why understanding geopolitical risk isn't optional anymore. It's mandatory for portfolio survival. The financial system isn't fighting one war. It's fighting dozens, some visible, some still lurking under the surface.
And the real battle isn't just about resources. It's about trust. When trust in supply chains, trust in currencies, trust in governments breaks, the dominoes fall faster than any algorithm can model.
Up next, how to survive it and profit from it. We'll map out the tactical strategies you need to build a portfolio that can withstand the next decade of Cold War volatility. In a world tilting toward chaos, survival isn't luck, it's strategy. And winning in the new economic Cold War requires a different portfolio blueprint, one built for volatility, fragmentation, and systemic distrust.
Today, we're not talking about maximizing returns during a bull market. We're talking about minimizing destruction during systemic fracture and positioning to seize asymmetric upside when the old order collapses.
It starts with gold, physical bullion, trusted ETFs like GLD or IAU, secure offshore storage in jurisdictions like Switzerland or Singapore. Target 5% to 10% of your portfolio. Gold is no longer just an inflation hedge. It's a hedge against the collapse of trust itself.
But discipline matters. Don't chase at the highs, layer in exposure over time, and watch counterparty risk, especially if using ETFs that promise but don't always guarantee physical backing.
Next comes energy. WTI crude spike after Bandar Abbas wasn't a one-off. It's a preview. Energy supply fragility is now embedded in the system. Position into energy giants like ExxonMobil and Chevron, midstream players like Enbridge, and consider broader energy ETFs like XLE for diversified resilience.
And it's not just oil majors. Energy shipping firms, companies transporting LNG and crude across vulnerable choke points, could quietly outperform as logistics premiums skyrocket under geopolitical pressure.
Then there's Bitcoin, not as a moonshot gamble, but as a digital defense asset. 1% to 3% of your liquid assets. Custody it securely. Expect 50% drawdowns at any time. But recognize Bitcoin is becoming the digital counterpart to gold for capital that no longer trusts fiat.
And for those with tactical risk appetite, Bitcoin miners like Marathon and Riot offer leveraged exposure, but with wild volatility swings. Know your tolerance and your timelines.
Rotation matters too. Tariff-resilient sectors are already outperforming. Defense contractors like Lockheed Martin and Northrop Grumman thrive under military spending surges. Infrastructure rebuilders like Vulcan Materials and Caterpillar gain as governments scramble to localize supply chains.
Emerging markets aren't immune to shocks, but selective EM exposure, especially to commodity exporting nations, can offer uncorrelated growth paths as the dollar weakens and capital reallocates globally.
Sixth, allocate 3% to 5% to defensive ETFs like XLU or IYH. Utilities and healthcare thrive when consumer staples falter. Defensive yield becomes a fortress when volatility strikes.
And seventh, keep dry powder. 8% to 12% of portfolio assets in T-bills, money market funds, or insured cash equivalents. Liquidity isn't optional anymore. In a volatility shock, it becomes a weapon, letting you buy what others are forced to sell.
Forget traditional 60-40 portfolios. Forget chasing yield. In the Cold War 2.0 economy, survival portfolios prioritize resilience, optionality, and access to hard assets over theoretical diversification models.
Today's playbook isn't about beating benchmarks. It's about surviving system shocks and positioning to compound through the storm.
Subscribe to Finance Frontier on Spotify or Apple Podcasts. Follow us on X for real-time financial intelligence. Share this episode with a friend and help us hit our goal of 10,000 downloads as we build the smartest macro community online.
And sign up for our top 10 finance stories newsletter at financefrontierai.com, delivered weekly with the biggest shifts in markets, strategy, and capital flows.
Because the new economic Cold War isn't coming. It's here. and the portfolios built for yesterday's world won't survive it. If you want to stay ahead of the biggest financial trends, don't just listen, stay engaged. Subscribe now on Apple Podcasts, Spotify, and follow us on X. Dive deeper with our full lineup: Finance Frontier, AI Frontier AI, Make Money, and Mindset Frontier AI, all curated in one place at financefrontierai.com. And if you're already with us, help grow the community by leaving a 5-star review on Apple Podcasts or Spotify. It's the best way to support the show and bring this knowledge to more listeners like you. If you enjoyed this episode, share it with a friend. Help us reach our goal of 10,000 downloads. We're counting on you. And don't miss out. Sign up for our Top 10 Finance Stories newsletter for elite macro insights delivered weekly to your inbox.
Before we go, remember that the information shared in this podcast is for educational and informational purposes only. It should not be considered financial advice. Always conduct your own research and consult with a licensed financial advisor before making any investment decisions.
Markets evolve, risks compound, and no forecast, no matter how strategic, guarantees future results. Manage your exposures accordingly.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Copyright Finance Frontier AI. Unauthorized reproduction or distribution is prohibited.